Today's episode of the How to Trade Stocks and Options podcast is powered by FinClub and their artificially intelligent stock picks. With nearly 90% accuracy for the first half of the year, you'd be crazy not to try FinClub stock picks while you can. I mean, before they get bought out by one of the big Wall Street banks, because their technology really is that good. So head on over to tryfinclub.com to get nearly $1,500 in bonuses just for starting your free 2-week trial. So join the club, the Fin Club, to get nearly $1,500 in bonuses just for starting your free 2-week trial at tryfinclub.com. That's tryfinclub.com. Today on the podcast, we're going to answer the question, what is a call option? This is the How to Trade Stocks and Options podcast brought to you by 10minutestocktrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10minutestocktrader.com, Christopher Uhl. Hey there, 10-minute traders, and welcome back to the How to Trade Stocks and Options podcast. Hey, before we get started real quick, make sure you like, subscribe, and enable notifications so you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. So today, we're going to be talking about a call option. Now, if you're new to options trading, this may be totally unfamiliar to you. But if you've been around options trading for a while, this is just going to be a review of what a call option is. So a call option is an agreement give the option buyer the right, but not the obligation, to buy a stock, bond, commodity, or any other instrument at a specified price within a specific time period. The stock, bond, or commodity is called the underlying asset, and the call buyer profits when the underlying asset increases in price. And we'll talk about that a little bit more in a minute. Now, I pulled this definition here from the internet, and that's not exactly the case here when a call buyer profits from an underlying asset increase in price. It's true and it's not true. With the call option, the call has to reach the strike price plus the price of what you paid for the call in order to just break even. So for example, if you were to buy a stock and it was a $100 stock, if you bought the stock outright, you would start to profit at $100.01. And with the call option, maybe you bought the 105 call. While the price of the stock may go up from 100 to 101 to 102 to 103 to 104, nowhere in that time are you as the call buyer actually guaranteed a profit, because the prices at expiration need to be greater than the strike price plus what you paid for it. So maybe you paid 50 cents for the call option. So your break-even price is now $105.50, but the stock's trading at $100. So your stock has to move 5.5% just for your break-even, where if you were to buy the stock outright, you would be profiting right away if it did go up. Now, there's advantages to buying a call option versus buying stock outright. First off, it's going to cost significantly less to control 100 shares, right? If you were to buy that $100 stock, if you were to buy 100 lots of it, that would cost you, how much would that cost you? $10,000, right? 100 times 100. So if you were to buy the 105 call for 50 cents, it's actually $50 to take control of those 100 shares versus $1,000. But your probability of profiting, if you were to buy the stock outright, is 50-50. If you were to buy the call option, it's going to be significantly lower because, like I said earlier, it has to move up 5.5% just to break even. So while it does profit when the underlying asset increases in price, it only happens after it's reached your break-even point. Now, some of the first trades that I ever placed, and I lost tons and tons of money, were long calls. In fact, I've recounted this story several times. I love to tell it, and it hurts so bad, but it's so true. In the first 60 days that I started trading, I lost 2/3 of my account. So let that sink in for a minute, right? You've been saving for years. You're all excited. You've been learning as much as possible. And you open your brokerage account. You put all your money in there. Your hands are sweaty because you're so excited, and you start clicking the buttons. Long calls all day, every day, because the market only goes up, right? Well, not necessarily. and it may not even go up to the strike price that you bought. So my mistake and why I lost so much money just right up front is I had no idea what I was doing. So before you get started trading, it's really key to just know what you're doing. I like to tell people to start with paper trading. Just figure out the system before you start putting money at risk. And for me, like the long calls, I remember actually like sitting in church and praying. And I know that sounds so sad, but it was true because I was looking at my account and I've been holding on to these things for so long, right? And day after day, I was losing money, and I was like, "But the stock market always goes up." It was around Christmas time. I was like, "That Santa Claus rally's got to come, right?" And it just never did, and I lost so much money because of that. So if you are looking to go long, buying a call outright doesn't always make sense. I mean, there's definitely strategies with long calls, but just buying a long call outright and hoping for the best, that's not a great plan, especially when you don't have a plan like I did. I certainly had no risk mitigation plan, and that was really my downfall there. So if you were to sell a call, right, buying a call means you want it to go up, and if you sold a call, you actually want the price to go down or even stay where it's at. So if I bought the 105 call for 50 cents, you could have sold that to me for 50 cents. So I would take $50 out of my account and give it to you. Hey, please give me the opportunity to buy these shares. And you would say, absolutely, I'll give you this opportunity. I will assume the risk if the price goes beyond 105. But I've compensated you for that risk. So you as the seller take in $50 in credit. Now for me, my break-even point to make money on the long call is at 105.50. Your break-even point where you lose money on selling the call is at 105.50 as well. But here's the key difference. If I'm buying the call, it has to go up to 105 in order for me to break even. Okay? Something has to happen. There has to be a move of 5.5% greater for me to make any money on the trade. But you as the seller of the call will actually make money if nothing happens. If it stays at 100, if it goes to 101, 2, 3, 4, even 5, you get to keep all of that premium that I as the option buyer paid you. So if you were inclined to think that the stock price was going to go down, selling a call is a way that you can have some wiggle room. You can have some buffer, right? You can have a 5.5% room to be wrong by selling that call. Now, granted, when you sell a call, you do take unlimited risk. And so that's why if I were to do it, I always do a spread. I spread everything off because I don't assume unlimited risk ever. And also it super decreases your buying power, right? If you were to sell the call on Tastyworks, they take 20% of the underlying price. So it would actually cost you about $2,000 in margin to hold that. But if you spread it off, you may be able to do it for $50, $150, something like that, versus $2,000 in margin. So there's a huge difference there. But the point is that, what is a call? It's the opportunity for somebody who's buying a stock, looking to go long, to take advantage of that for a small risk, right? In fact, you could look at it like a lottery ticket. That's the easiest way to make the analogy here. I want to buy a lottery ticket. I'm going to pay $50 for this lottery ticket. If the lottery ticket works out, I'll make potentially $150. If it doesn't work out, I lose $150. But something has to happen. I have to get all my numbers right. I have to scratch off everything in the right way in order to win. But you as the seller, okay, you sold me the lottery ticket. You don't have to do anything. You can just sit and collect the bets all day long because you know only a handful of these are ever actually going to turn into winners. And because of that, you can stack all these odds in your favor. And you can even buy insurance against the risk of it, going all the way against you by spreading it off, by making a call spread. So there you go. That's what a call option is. It does give the buyer the opportunity to profit bigly, as some people in office would say, if the stock price does go up significantly. But as the option seller, as the call seller, you can profit if it doesn't move at all, or if it goes down, or if it goes up just below your strike price. That's the real difference here. So there you go. That is what a call option is. It's definitely something that, there are strategies that work and strategies that don't. And, being able to mix things up and find what works for you is really what's key here. But before you go real quick, the platform that I use, that I recommend all the time, is Tastyworks. So if you go to trytastyworks.com, I actually will give you a huge amount of bonuses there. In fact, I think it's close to $1,500 in bonuses. And all you have to do is just create a free Tastyworks account, click a couple buttons, and there you go. You have all these huge bonuses delivered to you absolutely free. So make sure you go to trytastyworks.com in order to get these bonuses. Because if you go straight to Tastyworks and sign up, make sure you use the code 10minute. But to get all the bonuses, make sure you go to trytastyworks.com. So there you go. That wraps up today's How to Trade Stocks and Options podcast. Please make sure you like, subscribe, and enable notifications so you can never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode. Hey, did you realize that you could get the secret weapon that every investor needs right now to start changing your financial future for free? Yeah, that's right. Just head on over to TripleStockProfits.com and download your free Triple Stock Profit System ebook today. 10MinuteStockTrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10MinuteStockTrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10MinuteStockTrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client situation or investment objectives. 10MinuteStockTrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10MinuteStockTrader.com/legal. Thanks for stopping by.